All right. Hello, everyone. This is Wes Williams. I'm with Andrew Gaiziunas and Scott Harms with Turbadium. Today, I'm going to talk to them a little bit about their company, kind of how they met, and then what was the catalyst for starting Turbadium. You guys want to go ahead and tell me how you guys met and how you guys came up with the concept of Turbadium?
All right, so thanks, Wes. So where did we meet? We met in the dot-com days, 99, 2000, working at a database company based here in Silicon Valley, in Menlo Park, and Informix Software. Great place to work. Really kind of the foundation of my technology background and upbringing and working in deep technology. Just kind of continued to stay friends and talk about technology, talk about real estate. We were both had an interest in both those industries and how technology could, the adoption of technology could change it. So, fast forward here to 2017 when we founded Turbadium together with our third co-founder, James Quadra, just for really the marriage of real estate and technology and what it can do, what it can open up in the next evolution of funding.
Yeah, and I'll just add to that. So, since Scott and I both have that technical background, and he's really steeped in real estate, and you and I have talked, Wes, plenty of times on my background, political leanings, being more towards the classical libertarian type guy with the sound money and Ludwig von Mises and Hayek and everything. So this was this technology was also a really good way to look at bringing back sound money, using real estate as a stable asset class to reduce some of the volatility, using it as the basis of a new monetary supply. So that's why we picked real estate to start as well. Given Scott's background and given the stability of the asset class.
So who came up with the concept? So basically, the way I understand it is this: you can realize the liquidity in your property by tokenizing your ownership interest, taking that digitized ownership interest, depositing it into this virtual vending machine, so to speak, and out comes a cryptocurrency, correct?
Yeah. So it kind of all started as we were just discussing blockchain, Bitcoin, cryptocurrency, what's the next evolution of technology. And we started talking about real estate and this problem within real estate of financing and how the finance how your equity is locked up so much within your real estate asset, and current financing mechanism just has such a closed door. And so that's kind of how it started, and really grew from there, as Andrew can kind of explain on the technology side how it grew and how we understood and we knew that this type of new technology and applications built on top of the blockchain can do exactly what we're hoping to do.
Yeah, it evolved over time as well. So when we started out, just with the straight tokenization, similar to what you're seeing being done by others today and what we talked about in our last episode, and over time we started looking at, well, does the fact of tokenization and placing the asset tokens on a blockchain really deliver any value other than being able to now trade those bearer assets as a cryptocurrency? And we thought there was a little further to take it, and that's where we came up with that with the machine, with the Ubel, what we call the Ubel, which takes those asset tokens on deposit to generate a more fungible, more usable, general use cryptocurrency on the other end.
Right. Well, and that makes sense. Because right now, in the way our current system works, in order to release the equity in your home and realize that liquidity, you'd have to normally go to a mortgage lender to do that, or a finance company to essentially borrow the money from them, go through this entire process, paperwork, credit checks, things of that nature, and then essentially lien your property to realize that the liquidity, and somebody gives you money for that equity. So in this case, you're essentially, that equity is there. You just don't have a means of immediately realizing it, so you can go and spend it at your corner market. Now you can do that with what you're proposing, correct?
Yeah,
you sure can. You sure can.
Well, and it's kind of funny because I won't say the name of the bank because I don't want to get anybody in trouble. But even when we were opening up our business account, last year, and the banker themselves was talking about our concept and saying, hey, I've got customers that they've got a $2 million house and they've got some medical bills and they can't get a loan on it. They can't access the equity because they don't have the income. Maybe they're on fixed income or disabled, but so they can't qualify for loan, even though having a $2 million house free and clear, they can't get 50, 60 grand out of it. So they're resorting to, more predatory options like reverse mortgages and bad loan products. Whereas here it's not based on credit. It's based on your asset. If you've got an asset, you've got equity and you have money. So you should be able to access it.
Right. So from the technical standpoint, it's fairly easy to do. So in our last episode, we talked about some of the challenges, the legal challenges of being able to realize that liquidity, because it's not just as easy as, okay, we're going to tokenize a piece of property and we're going to place it onto a blockchain and start selling it willy-nilly. I mean, you got to figure out a means to bridge that gap, because ultimately you're going to have token holders that are trading this currency, and there could potentially be liens and judgments against the property that's tied to. So here in California, we think we figured out some of the challenges that do that. But what are your thoughts, big picture, large scale? Where do you want this thing to go? I mean, you want to be tokenizing assets all over throughout the entire world?
We're focusing on areas that we can have the most effect on. The moment that's California, and quickly can be replicated in all 50 states and territories of the United States. The jurisdictions and the law so far, even though there's tough things in regards to cryptocurrency side on the SEC, the law is the most favorable at the moment to do what we're trying to do here in America. So we'll do it here and then continue to tokenize the world.
Yeah, and to get started, obviously we need something that's going to be stable, that can't be in some other developing nations, assets can be renationalized or reappropriated with a single stroke of a legislative pen. So obviously, to get a good start, we needed to pick a stable asset class, and that's why this jurisdiction makes sense.
So in that sense, creating a cryptocurrency that is tied to a hard asset like real estate, it's, from an economic perspective, it's a little easier, wouldn't you think, to stabilize that inflationary environment, because you're not continuously pumping money into a system? Is that the idea behind creating this asset-backed cryptocurrency?
Yeah, it is. You have an asset class, real estate, whether it's commercial, residential, that has a nice trend line. It's going to be worth something over time, something a little bit more over time. Nice, easy, straight trend line of that appreciating asset, because it's a scarce resource here on the globe.
So yes, and to add from the monetary standpoint, that stability comes also into play, because you're releasing a very critical part of the supply-demand equation, which is the supply. Right now, a lot of the what we call fluff coins, which are the ones based on math, they're better than fiat. They're an improvement over fiat currency, but still have a flaw in which the supply is fixed. It's fixed for a reason, right? And it's a very good one, that they don't want any kind of centralized manipulation of the currency supply. But that locks supply in the way that now price is dictated only by demand. Versus in our system, if there's something out of equilibrium, if the price of turba starts going up too high, it's overvalued. That incentivizes people with assets, with tokenized assets, to deposit more tokens, generate and cash in on that premium. That adds supply, that adds selling pressure. So it's free market forces trying to kind of fight to bring stability and equalize, everybody competing to equalize on a price level that's appropriate.
Well, now, tell me what makes Turbadium different from a lot of the other ICOs out there that have promoted an asset-backed cryptocurrency.
Oh, every real estate blockchain company today that's on the marketplace as a current platform, a real working platform, has done it via the ICO route, and they've raised money not only to buy real estate and invest in real estate as that asset-backed currency, but also to use those ICO funds to run the business, to run marketing, etc., to move their currency forward. And so in our view, they've done everything completely backwards. They decided to take the currency first and then decide how I can value this currency with some asset that I determine in the future.
I mean, to a pure play money geek, they're doing everything wrong. One, they're printing the currency first, which if it's really asset backed, how can you do that? You're just basically promising that you won't turn on the printers down the road, provided that everything works out and everything's good and stable, right? So, and then to issue the currency first, sell it, and then use those funds to go out and acquire assets to slide it in underneath them. If you're raising $10 and you spend $6 of that dollars on developing your platform, you only got $4 left to go buy the assets to back it. Now, you're not going to make the original investors whole unless you bring in a second round, and you're depending on the appreciation of the actual currency to actually make previous rounds of investors whole. I mean, there's already a name for that. It's called a Ponzi scheme. It's not a real reason to create an asset-backed currency just to go slide something in underneath it after the fact.
So is that one of the reasons why Turbadium hasn't done an ICO yet? They want to go ahead and find the assets to tokenize first, and then create the currency after that.
Yeah, no, I mean we're prohibited from we can't do an ICO because our platform's been designed. The only source of our currency is the deposit of asset tokens. So you could think about our first ICO. We're not even going to be involved. It's going to be somebody with asset tokens deposits it and generates that first pool of turba that goes into circulation. So there is no traditional ICO in that regard.
If I was a homeowner or a property owner, and I said, you know what, I have equity in my home, I can't get a loan, how do I go about tokenizing my property and then realizing the liquidity through this cryptocurrency system that you've created? Would I go and just come to you and say, hey, I want to tokenize my property, and then you guys create a digital representation that gets deposited and then it spits out cryptocurrency? Or is there like an underwriting process that somebody has to go through in order to get to that point to tokenize their asset?
Yeah, well, I mean, tokenizing we talked about in the last episode, right? So they'd have to tokenize their asset. We have partners that do that. We do it ourselves. But the tokenization part, I mean, if it's a commercial real estate that's worth $100 million, they may not want to do the trust model. They might want to do a Reg D, or throw some kind of holding company over it. But the tokenization, once they're completed with that, then yeah, they bring us the asset tokens. They deposit them into a currency that is approved that type of jurisdiction and asset class for it. So in the case of real estate, those are California and Illinois that launch.
Who makes the determination at Turbadium as to whether or not a specific piece of property is right for tokenization? Is there an underwriting process that you guys go through?
Yeah, who decides is the currency holders. Now we've got an initial rule set that we have to sign off on initial tabs. We call them tabs, which are the asset blockchains themselves, to be compliant against a certain format that's been designed. But eventually, as the asset pool grows and gets more diverse, those circuit breakers are going to be cut, and the currency itself, the rules of what constitutes acceptable tokenization, goes and moves to the currency holders themselves. So they start managing the currency as a community.
And then ultimately, so Turbadium essentially just wants to be that virtual vending machine, token vending machine, correct? That anybody can go and take this tokenized asset, deposit it into the this virtual machine, that then they can realize the equity in their property through this turba currency.
Yeah, exactly. Because we're not even limiting ourselves to real estate. I mean, that's where we're starting. We have to give our machine something to do to start. It may not be tokenized assets in the future. People may create other currencies that are based on depreciating assets or things with completely different characteristics, maybe utility rights, anything with a value, anything that has a value and that value can be tied to a token. or a piece of cryptocurrency can be deposited to generate something else. So we definitely would be, divorcing ourselves from that.
And all the currency holders, do I understand, or just the token holders, they have some sort of voting rights built into to their currency and tokens?
Mm-hmm. Yeah, no, it's a core part that if you have any amount of the currency that you have a say in its future. So there's a voting mechanism in place for adjusting the rules, adjusting what asset classes and jurisdictions are depositable into your particular currency. The idea being obviously that there may be riskier asset classes that people don't want backing their money, but others that may want different performance characteristics would be open to using. So, we talked about some of the developing nations, like where they can legislate assets away with the stroke of a pen. Well, maybe some folks are comfortable with that risk and are comfortable with using a money that's based on those assets. But there's the voters, the votes come from the currency holders themselves. So if one currency says, no, we don't want that in our money, somebody can go and create another pool of money that's going to be specifically for that type of asset class.
But then again, I guess I think some people would look at this and go, okay, well, you're still centralized. It's not completely a decentralized system yet. But I guess in a sense you kind of are, because all you really are is the mechanism to exchange the cryptocurrency, and then you're giving all the governance rights to the token holders and the currency holders, which is a good thing, I would think. It creates a more decentralized platform.
That little bit of centralization up front are more circuit breakers to make sure things come off to a stable start. I mean, even minorless, feeless cryptocurrencies, they still have little proof of works that they throw in there to avoid people from spamming the system. They're little things that take 4 or 5 seconds to generate, but it's just enough to keep people from spitting out noise and abusing the system. So there's got to be a little bit of centralization up front. But that's just to kind of like get the boat launched.
To get the network going, yeah.
And then we've got a plan set roadmap of milestones as the currency hits, that we relax those and cut those away. So that's baked in as hard as the mathematical limits of Bitcoin production, right? So those are coded into the platform that once you hit those milestones, that centralization disappears.
Okay, guys, I think that's all the questions that I have.